Hello, everyone. Welcome and Happy New Year. Thank you for joining today's web conference, the City National Rockdale 2021 Outlook. My name is Elizabeth Dooley, and I'm a Senior Portfolio Manager at City National Rockdale. With us today, we have Tom Galvin, our CIO, Greg Kaplan, Director of Fixed Income, and Charles Luke and David Abella, Senior Portfolio Managers. The views and estimates you hear today are sourced from our investment committee's weekly meetings. This reflects more than 100 years of combined experience in financial markets. During today's call, Tom will begin with our overall 2021 outlook and strategy, and he will also discuss large cap core equity. Then David will cover high dividend and income. Greg will provide an update on core fixed income, and Charles will discuss opportunistic fixed income. At the end of the presentation, we will all be on the line to answer any questions we receive from you during the webinar. A few logistics before we get started. We welcome your questions, so please type them into the console's Q&A window anytime during the session. And if you would like to download a copy of the presentation slides, you can do so in the resources window to the right on your console. I'll now turn the call over to Tom Galvin, CIO of City National Rockdale.
Thank you, Elizabeth, and hello, everyone. Thanks for joining us today, taking time out of your schedule. As Elizabeth said, we're going to discuss our 2020 outlook. It's going to come with an overview on the markets, and then the individual guest speakers will discuss their asset classes and strategies. So let's dive in. 2020, what a year. Good news is it's in the rearview mirror, and we believe we can look at the road ahead with optimism and confidence. I'm sure we can all remember March and April of 2020. The uncertainty that existed then was like nothing I've experienced in my 36 years of investing. Uncertainty surrounding the first global pandemic in 100 years. Historic evidence that most vaccine development efforts fail, and those that do succeed generally take years to develop, was not very comforting. Combined with the unprecedented shutting down of national economies on a global scale, made the risk of severe and prolonged capital destruction very high in our view. And during these periods of high risk of capital destruction, CNR believes it is prudent in our management of wealth for individuals to adopt a capital preservation strategy, which we did. As events unfolded, infections subsided, massive and unprecedented policy responses were put in place, reopenings occurred and the economy recovered, we lowered our risk management approach and opportunistically redeployed cash. With the unexpectedly positive news of 90 to 95% efficacy on the vaccines in November, with unexpected, underlined twice, the risk of capital destruction finally abated, and we completed the shift to capital appreciation in our pivot to the post-pandemic expansion. We looked at 2021 and coming years with heightened confidence on the economy, as well as confidence in our positioning and expectations for performance. Positive reversion to the mean for our high dividend and opportunistic income strategies are high. This combined with our differentiated asset allocation strategy, continued value added expected from our regional equity allocations, the focus on differentiated income and alternatives we believe will serve our clients well in 2021 and beyond. As highlighted on the left side of this chart, the uncertainty was enormous, especially in the first part of 2020. The combination of substantial uncertainty regarding the implications of economic and profit growth due to the pandemic, potential policy responses or lack thereof, presidential election outcomes, and what would the behavioral responses by consumers and corporations be to these things, created a uniquely negative backdrop. And as we stand today, clarity and visibility has replaced fear, uncertainty, and doubt. Policy measures remain supportive. Washington correctly is rallying around the need for more fiscal stimulus and perhaps most importantly, defying those expectations. We had the best case outcome of 90 to 95% efficacy of vaccines that were developed with a previously unproven technology. So the combination of these factors will have bolstered our confidence in the outlook and will continue to bolster confidence by consumers and corporations in coming months. This view is visually supported here by our speedometers. Now, while in the near term, economic activity, especially outside the U.S., will be held back due to the pandemic, taking a 6 to 9 month forward view, our key economic and financial indicators are supportive of a more optimistic and confident view. Foundational to this is the massive strength and continued support of our monetary and fiscal policy measures, all of which are very, very green. I'll have more on this in another slide. These policy responses have bolstered the outlook for the consumer. Corporates and their profits are bolstered, and these are reflected in our speedometers. Bottom line, look at them all. The speedometers are supportive, we believe, of optimism going forward. Now, as this slide shows, we believe our journey through the valley of COVID, as I like to call it, is nearing an end. This model we're showing you here from one of the most accurate forecasters as the pandemic has unfolded in the U.S. does paint a very positive picture. Yes, we continue to expect bumps in the road in the manufacturing and supply chain. New strains of the virus do present challenges on the vaccination front, and no one truly knows how long the benefits of the vaccine, once you get it, will last. But we believe the process is gaining momentum. There's a renewed sense of urgency, especially in the U.S., and these are good things. On the y-axis, and represented by the blue and black sections, you can see that the number of people receiving vaccines in the blue and those who have already had immunity from being infected previously in the black there, the combination of those two is expected to ramp up significantly, reaching 70% or so of the population in the May-June timeframe. Now, the narrow line, the skinny narrow line you can see on the left there, that's the projected decline in daily new infections. We have likely seen the peak for this winter's infection cycle, and new infections should decline to near zero, such as what we saw in 2020. Now, by the time the fall and winter of 2021 arrive, increased vaccine supply, lower distribution challenges should combine to pave the way for the control of and possibly the end of the pandemic, barring any radical new strain that comes along, which is a low probability outcome in our view. Policy response from Washington has been massive, timely, well-targeted, and will continue to be supportive. As this slide shows on the right, the size of the Fed's balance sheet has almost doubled in the last year to over $7 trillion, and we see no change to this unwavering support from monetary policy. The left side shows the fiscal response as a percent of GDP in response to COVID last year has been massive and dwarfs the amount of stimulus by far that was added in response to the great financial crisis. Last year alone, 18% of GDP was put out in all the fiscal packages that were passed. Going forward, we continue to expect the monetary printing presses, the fiscal support will be running 24/7. In December, we had the $900 billion recovery and relief bill passed. Our expectations that we'll see another, call it $1 trillion plan in coming months. And so we'll have an additional 6% of GDP will be provided in fiscal stimulus this year. Now, the benefits of this massive supportive effort has been numerous. Probably foremost has been the positive impact this has on the consumer. So as we show here, on the left side, lifting household net worth has risen significantly due to the rise in financial markets, the increase in home prices, all of which are directly related to the massive policy measures that have been put in place. On the right side, debt as a percent of disposable income for consumers has fallen to all-time lows. Now, this is due to lower interest rates and the benefits of fiscal stimulus flowing into consumers, which has bolstered disposable income. But the lower debt burden is a positive development. So when consumer confidence and optimism about the future recovers, as we expect in coming months, it'll be foundational for a multi-year expansion. There's a lot of pent-up demand for services in the economy that have been hit hard by the pandemic. I don't know about you, but I can't wait to go back out into the world, go to my favorite restaurant, travel, return to theatrical and sporting events. There's a lot of pent-up demand out there. Now, the other important part besides the COVID benefit as it relates to consumer behavior over the next several years is the outlook for jobs. When consumers feel confident about job stability and the future of their jobs, they're willing to spend more and take on more debt. As this chart shows, the labor market has improved noticeably. Approximately 2/3 of the 25 million jobs initially lost in April have already returned, and about half of the remaining amount have been temporarily laid off and should return to work. Now, while the next few weeks could see modest increases in the unemployment news as COVID impacts the economy, we view these as temporary and believe that we will see a continued improvement in the job outlook in the spring of 2021. Pulling it all together, support by consumer, or a consumer that's getting better, continued support by monetary and fiscal policy, we believe that it's going to set the stage for a multi-year expansion. This chart has a lot of lines. The dashed line you see is the trend line of potential GDP growth. The black line is what has occurred in the past and the growth that is expected in the next year or two. To us, it appears that the economy won't get back to its potential uptrend until 2023. At that point, the most likely outcome is a return to growth of around 3%, as we illustrate with the yellow line, with a couple of other outcomes highlighted in red and green. Our specific CNR forecasts are illustrated here on this slide. One new area to highlight for you, we have modestly increased our forecast of GDP for this year to a range of 4 to 6% because of the fiscal stimulus, positive vaccine, and the improvements we see for the consumer. Corporate profit growth should be 20 to 30% this year as well. Shifting gears, as it relates to equities, we remain of the view that returns can be enhanced by having a focused allocation to the regions of the world that will do best and minimize exposure to those that are likely to lag. Based on our analysis of traditional macro forecasts and supplemented by our proprietary 4Ps framework, which if you haven't seen, feel free to reach out to us. We can send you copies of the white papers and the webinars we've done on it. We continue to believe the U.S. is the preferred developed market region to invest in, and we remain overweight. While infection rates in the U.S. have been among the highest in the world, the policy response has also been the highest in the world. It's been massive, and compared to Europe, we are way, way ahead. We also continue to believe emerging markets in Asia will continue to outperform other emerging markets. Now, this chart shows returns over the last 5 years. You can see the places we've been overweight. U.S. high dividend stocks have really been much better performers than other developed markets such as Europe and in EM Asia. Strong outperformance there as well, significantly helping our clients' portfolios on a longer-term basis. Now, while absolute returns over the next 5 years are unlikely to match these, we continue to believe our regional tilts will provide extra returns to our clients and assist in achievement of those goals. So you may be thinking, Tom, that sounds good, but aren't stocks expensive? Well, you would be correct. Stocks are expensive on an absolute basis. The market lows, or from the market lows, stocks have been on a historic tear, a freight train, as I like to call it internally, a strong advance without really a meaningful correction anywhere along the way. And we have moved into the overvalued zone just on a pure absolute basis. Now, as we said today, there are many sectors of the market that are showing evidence of euphoric valuations and irrational exuberance that are clearly being influenced by retail day traders who are more than 40% of activity in options market, 23% in volumes of equities. This chart illustrates, though, from a longer-term investment perspective, which we as longer-term investors focus on, stocks remain attractive compared to bonds. Using our base case forecast of 170 in earnings for the S&P this year, it gives us an earnings yield of around 4.5%. Current 10-year Treasury, last I looked, was about 1.04. So the spread, known as the equity risk premium, is about 3.3%. And compared to history, it's still very attractive. So what does it all mean for what you should be expecting in your portfolios and how should you be positioned? Let's take a look here. So for some time now, it's been CNR's belief that it will be increasingly difficult for the traditional 60-40 portfolio to continue to produce the historic returns as it did in the first column, as we show here, from 1975 to 2019, and in a decade of before 2019 in the second column there. So our view continues to be that returns for stocks and investment-grade bonds are going to be lower going forward. We're not going to see 12% for stocks for an extended period of time, 8% from investment-grade bonds to get that 10% historic 60-40 return. We think for planning purposes, 5% is more prudent, 7% for stocks, 2% for investment grade. So if investors need more or have the risk tolerance to go beyond the 5%, we do think it's prudent to consider alternative asset classes to meet their goals. This chart shows our expectations for 2021 by the major asset classes and where we stand in our pivot to the post-pandemic expansion. The colors show our relative weights. So for example, we are neutral equities. So if you look at the bottom, equities are highlighted in yellow, but we are overweight U.S. stocks in green and underweight non-U.S. developed markets in red there. Now, for each strategy, we also show the expected returns for the year on top of each bar. U.S. growth equities, core equities should increase around 6 to 10%, not as robust as they were last year, but 6 to 10%, driven by earnings growth, bolstered by the post-pandemic expansion. In small cap stocks, a sector we've been absent in for some time, we recently increased our exposure at the end of 2020 because they should benefit from fiscal stimulus in the U.S. We see good, strong returns there, 6 to 12%. Dividend and income stocks should have a strong rebound year as confidence in the ability to pay and grow dividends, which have attractive yields of around 4%, combined with historically low valuation, should increase investor demand. So we're expecting a nice rebound, 6 to 10%. Opportunistic income returns, we believe, will be bolstered by defaults remaining low, spreads continuing to tighten, and with yields at 4 to 5% or so, total return of 5 to 7% looks solid. High yield munis return, adjusted for taxes, of 5 to 7% should also be helped by an improvement in the economic activity as the year unfolds. And for investors that can invest in alternatives, we have differentiated solutions from railcar leasing that should return 6% and CLOs at 12%. All in all, 60-40 portfolio, as we see it, should produce 6 to 8% returns in 2021. Shifting gears for a minute to core equities, my last two slides before I hand it over to David. During 2020, we pivoted to a post-pandemic expansion as events unfolded, and we're expecting returns overall, as I said, around 6 to 10% for the year. So what's illustrated here is some of the cash redeployment that we've done. We have focused on undervalued quality franchises that will benefit from the economy's rebound. For example, when we all start to venture back into the real world, go into our favorite malls, we'll likely stop by our favorite coffee shop to pick up a cup of coffee along the way. As spending patterns return to normal for consumers, demand for more focused loans to help purchase those products are going to recover too. Finally, with a recovering economy, industrial production, part of that inventory rebuild cycle, is likely to increase. Sales of like autos, for example, should also increase, and that should increase demand for semiconductors that go into autos and industrial products. Now, embedded within all these purchases and the pivot to the post-pandemic expansion, we remain focused on high-quality companies, sustainable business model with reasonable valuations. Our favorite secular themes are shown here. Those that will benefit from the multi-year expansion, foremost among these, we believe, is the normalization of consumer behavior, an emphasis on domestic growers, and a continuation of the digital revolution. So with that, I'll stop and turn it over to my esteemed colleague, Mr. Abella. David?
Thank you, Tom. So I'd like to start with this slide of consistent income and strong returns. And it's a look forward to 2021 and beyond. So after a tough 2020 year for us and for dividend stocks in general, we are looking forward to a much better future starting this year. And that is really driven by a few things. And as Tom mentioned, a return to economic normalcy post-vaccine. So as the economy becomes more normal and not just pockets of high growth and more distributed across different sectors, that has been traditionally very good for our companies and our stocks. Secondly, and very importantly, is this low rate environment we're in, and the fixed income team will go into that in even more depth. But I would say that, running this strategy since 2002, this is the best rate environment I've been, and it looks to be a great rate environment for an extended period of time, which is something that post-coronavirus has been a great driver in the past. The third thing is dividend growth. So our dividend growth, actually, we were very focused on dividend stability in 2020. It made us have a bias towards being a very conservative portfolio. So some of the high beta upside, we missed some of that as the year went on. But however, going forward, we have a great positioned portfolio to capture dividend growth and increase dividend growth as the economy continues to recover, again, hopefully post-vaccine. And then the final thing is valuation. So these stocks are at a relatively better valuation than the market as a whole. Some pockets of our dividend stocks are great valuations. Other pockets are more fairly valued, but still, I'd say, overall attractive. So the next slide is really going to just look at that versus a spread to Treasury, and this is a very, very wide spread historically, and that gives us a lot of reason for optimism. And the spread had been at its maximum kind of during the disruption of the first quarter of last year, but it's still a very attractive spread. And given the fact that rates are likely to stay low for a while, that gives us a lot of optimism for our dividend stocks. And it gets back to an old theme that I used to use back in 2002 and 3 and 4, searching for yield. Like the yield alternatives weren't all that attractive, and so the higher dividend yield off the bat plus the growth, that was a great 1-2 combination for many, many years, and it looks like it could be a return to that environment, which was very positive for us in years past. The next slide is showing the relative valuation. There are pockets of the market that are very expensive, and then there are pockets that are very speculative. Fortunately, a lot of those speculative areas are not in our universe, but it makes the overall market a little pricier. So there's this gap to our stocks that when we buy them, we're more confident that we're getting a reasonable valuation. The next slide kind of wraps it up in a different way that shows in years past, when you had that type of relative valuation gap, that the following performance was very strong. And that was especially after kind of 99 and 2000. That was a long time ago, and this might be a smaller version of that, but it has given us some optimism in the past. So I like this slide as what could happen. Overall, though, wrapping it up, the strategy has given consistent return and income over the long haul. This is a graph that shows the actual composite returns going back to 2002 2002 shouldn't be on that graph. I apologize. That was a partial year. So 2003 was the full year results. And so you can see that it's been very positive. The kind of the glory years, if you will, was kind of post 2008, coming out of that hard market crash and the Great Recession. And we had 2009, 10, 11, 12, those a number of years in a row. And that was driven off of a more stable economy, recovery, and low rates. So we're hoping that that kind of environment and the recipe is there for a repeat of that, which gives us some optimism. And on this graph, you can see 2019 was a great year. It's sort of lost in the fact that 2020 was so disappointing, but we do see the ingredients in place for a return of that kind of 09, 10, 11. So again, driven off of low rates, dividend growth, valuation relative to the market, and a more stable economy post-vaccine. So with that, kind of wraps it up, and I will forward it to our fixed income speakers.
Super. Thank you, Dave. Good morning, good afternoon, everyone. This is Greg Kaplan. I'm going to talk about core fixed income today a little bit. And after a very strong year in the fixed income markets last year, where we saw the Fed cut rates 150 basis points and 140 basis point drop in the 10-year Treasury, we saw the Barclays Broad Treasury Index to return a very, very strong 8% last year. The Broad Barclays Aggregate Index, 7.5%. And it seems like an obvious question to ask where we go from here. So the key points this year in terms of core fixed income is, first and foremost, we do not expect any action out of the Fed. Fed policy has remained extremely accommodative and supports risk assets broadly. We don't see the Fed funds rate changing. We don't see a change in the balance sheet management in terms of quantitative easing. We do expect broad market rates to rise modestly, but not that much. And I think that's somewhat counterintuitive in light of a more optimistic outlook on the economy. So we've increased the expectation for the 10-year about 10 basis points from last year's range to 80 to 130 basis points to end the year. This morning trading, actually, we broke back below 1%, and there's a lot of different factors involved there. We do think inflation will firm. We do think inflation will probably test investors' resolve in terms of what they expect out of inflation, but longer-term trend inflation is not likely to change. That's a major input in terms of long-term interest rates, which leads into our call that when long-term interest rates spike up on that inflation fear, that should be an opportunity to extend duration as well as buy longer-term assets. In terms of credit, we see both corporate as well as municipal balance sheets stronger and likely to improve. I think some of the dire predictions that we saw post-pandemic or post-initial months of the pandemic, I should say, are not really bearing fruit. It's not nearly that bad, and most balance sheets are in much better shape than post-Great Financial Crisis. We continue to favor higher-yielding opportunistic asset classes over lower-yielding investment grade, from a return standpoint as well as a risk standpoint, but we do expect positive returns across the board, so low single digits for investment grade fixed income and mid-single digits for higher yield that Charles is going to cover here shortly. So shifting over to the Fed really quickly, the bar for the Fed to raise rates was raised pretty significantly by a policy shift last fall, so it's really important to remember that the Fed favors core PCE. So as far as its inflation measure, and they're looking for full employment. And what that means is really a moving target, but their policy will allow core PCE to run hot, and that is still at a very low level. So inflation expectations this year have certainly heated up, but that's expectations, it's not actual inflation. When we do get into late first quarter, early second quarter, you will see what's called base effects. So low inflation numbers 1 year ago are going to make so the year-on-year comparisons look large, but longer-term trend inflation is not likely to change that much. I'll get to that some more in a moment. In terms of the Fed, we've all seen that phrase, but Chairman Powell has made it really clear that the Fed decision makers are not even thinking about raising rates. They're also not thinking about making any changes to quantitative easing. So it's really, it's shifting policy back over to the fiscal side. That's really where the focus is. So monetary policy from our perspective, so is really on the sidelines for the year. There's been a lot of recent fear as far as taper, and we simply don't see that happening. You really need to pay attention to Fed leadership and not worry about the noise about some of the other speeches being made for folks who are not really decision makers. The graph that we're showing here is the most recent 3-year forecast from the FOMC, and what you see is that the median Fed funds forecast is unchanged through their forecast period. Most people on the street actually push that further out. We don't expect the Fed funds change until 2024, 25, or later. Shifting over to inflation, this is a very complex topic, but I'll try to keep it short. What we see in terms of short-term price adjustments does not translate to a long-term trend inflation increase. The Fed is looking at what we're experiencing right now as largely transitory, and 2 key measures that we really look at here in the graphs below. So on the left, we look at the output gap. The negative output gap is deflationary, and we are still currently in a deflationary output gap environment, and we do expect that to firm and get better. It's going to improve, but it's still not going to get back into inflationary territory for years to come. So on a similar note, if you shift over to the labor market, we had a lot of damage to the labor market. Jobs will come back. We will see a lot of improvement there, but the employment to population ratio is still going to be weak even when the unemployment rate looks a lot better. The Fed looks at both, and it's not going to be enough to pull the Fed off the sidelines. One common question is really expansion of the monetary base. As being inflationary, the monetary base has expanded pretty dramatically. So that is true, but the money's not circulating in the system. It's either sitting on the Fed balance sheet, it's sitting on bank balance sheets, or people simply aren't spending it. So velocity of money is actually very, very low historically. So when we shift over to municipal credit, a lot of concern about state and local governments. We've seen a lot of revenue volatility. I love this graph. This is one of my favorites. You see there's a wide variety of experiences. So really what you're looking at here is tax revenue from March to October of 2019 relative to March to October of last year during the worst of the pandemic. And the experience varies widely depending on what the actual structure of the state and local government tax structures are. And broadly speaking, states that are reliant on tourism and places where people gather, like Hawaii, like Florida, as well as the ones who are extremely exposed to the energy sector, such as Wyoming, such as Alaska, have fared much worse. But the bulk of states have really done quite well. They've adapted, they've adjusted, they've had enormous flexibility, and the projections going forward actually look quite good. So it varies quite a bit. So great example, state of California, where 6 months ago, we were looking at very, very dire predictions of about a $54 billion hole in the budget, and now we're actually looking at a surplus and numbers that compare favorably to not 2020, but 2019. So again, so it varies pretty dramatically. These credits only represent about 30% of the market, so the other 70% is going to be revenue bonds, and you can certainly pick your spots. Shifting over to high yield municipals, even though this isn't part of the core fixed income world, what we're looking at here is it's really important to remember that this space is almost entirely revenue debt. This is not state and local government tax-backed debt. These are very different credits. One of the largest sectors within this credit is senior living, which has been hit particularly hard by the pandemic, but there have been pockets that have been strong. We see a lot of good value there. Spreads, broadly speaking, through that entire space are actually quite attractive. The graph here shows that spread as being at least average, but actually slightly wider than average, and still having a lot of room to run. One of the themes through the fixed income markets in general is the global search for yield. So when we look at spreads that are average, we really look at a situation where we are going to go back to historical tights and probably through that. which provides a tailwind to performance. So we're very optimistic on that side. Shifting over to a corporate credit, similar story here. We've seen investment-grade corporate credit spreads go back to pre-pandemic levels, not quite back to pre-great financial crisis levels, but that global search for yield will drive that tighter. And we're seeing corporate balance sheets where we saw an awful lot of debt issuance last year, raised a lot of concern. But remember, a lot of that debt issuance was done opportunistically for those companies to strengthen their balance sheets for the unknown. There was so much uncertainty last year. So they're sitting on a lot of cash. There's a lot of health there. It's not a credit concern. And we've finally seen the upgrade downgrade ratio, the number of credits getting upgraded relative to the number of credits getting downgraded, finally turned back positive again. The point is, we've seen the worst, and so there's still a tailwind from here. And that's a good segue, so I will stop there and actually turn it over to Charles Luke, who runs our tactical fixed income side, to address that further and the opportunistic credit world.
Great. Thank you, Greg, and hello, everyone. I'm going to pick up right where you left off, but transition us into higher yielding markets. And within that, there are 4 points that if I could hope everybody would walk away with from my comments, these would be it. And the first is that, as Greg mentioned in his last slide, from a relative spread perspective, there's certainly no doubt that this same trend has occurred in high yield markets, and we've seen a tremendous rally off the bottom in March, absolutely no doubt. But when we make relative comparisons to investment grade, and we also factor in all the comments Greg made about the Fed and monetary policy and the stability in rates that that's created, we think that high yield remains incredibly attractive. And when we actually look at that valuation of high yield markets on a historical basis versus investment grade, so we strip government bonds out of it, that spread, that yield differential remains slightly above average. So we do not see froth in high yield markets relative to investment grade. The second thing I'd like everybody to go home with is that when we think about defaults, which is the most important thing about investing in high yield, the actual forecasts that have been predicted from March have not come true. So if we look at Moody's, which is a bond rating company, they projected default rates around 15% in US high yield assets. But if we look over the last 6 months, the highest level of trailing 12-month default activity was back in October and November, which was around 8%. It's now trending below 7% and continuing to decline. And we see similar behavior across all high yield markets if we go into emerging market high yield, if we go into leveraged loans or structured credit. And I also want to introduce a distinction here between the risk of loss and volatility risk, which is very important. We've got a slide on that I'll come back to. The third point is that we believe we're at an extremely good point to be investing at the beginning of the next credit cycle. So when we see rallies like we've seen in the midst of a downdraft that we saw from the end of Feb to the middle of March, and the economy 8 to 12 months later begins to recover, lower rated troubled sectors and companies really start to rally despite absorbing very high levels of defaults. So we'll show you that. And then my last point today, when we speak of impairment and we look about positioning and where the best opportunities are, I want to compare 3 sectors: US high yield, leveraged loans, and structured credit. And we believe overall that the most attractive sector to us is in the structured credit space in below investment grade rated, what we call mezzanine debt. It has a higher relative yield, it has a structural advantage from a supply and demand perspective, and we also have layers of subordination present in the asset class that protects us from defaults. So despite higher levels of volatility every now and then, we do believe that this protection is superior in CLOs and structured credit versus owning bonds or loans outright. So the first slide that I'm going to show everyone, and many of you will be familiar with this one, we've used it a lot over the last 8 months, but we've expanded it a little bit and adjusted it for distressed credits. But driving home the point of relative valuations in high yield, if we just take a look at where investment grade bonds were pricing on 12/31/20, we were at 1.7%. If we look at all of the core high yield asset classes, from US high yield, EM, emerging market, leveraged loans, we have about a 300% yield advantage across high yield, which to us remains attractive. And then in CLOs, we still have this sort of market inefficiency that's present where we're seeing yields north of 7%, but we also have that structural subordination that we'll talk about in the last slide. On the next slide, zeroing in on defaults, and this is a little bit of a busy slide, so I'll take a second to explain it, but we want to focus on two things. Defaults should not be feared, and the reason why is if you look at this blue line over history relative to the gray line, when the blue line spikes, the gray line tends to spike 8 to 12 months before that. The gray line is returns. So we know that as we hit market bottoms, default rates tend to rise after that, but returns tend to happen before that. So the rise in defaults is not really something that should worry investors, we believe, as much as often is the case inside of the media. The second thing I want to focus in on this slide is the yellow circle. When we look at default rates, we peaked around 9%, again, back in October and November, but we've come down pretty dramatically here, about a percentage point, and we continue to fall. So that hook down is very important to us and signals that there is a lot of stability coming into the high yield market. Shifting to this comment I made about risk of loss, so principal impairment versus volatility risk, I thought this was a great way to illustrate it. So if we look back to 2020 and we look at all of the credit asset classes that we're a part of here at CNR, when we look at that, we had very big dislocations, right? We had 13.2% even in investment grade corporate bonds. We were down almost 30% in CLOs. We had some major swings, and it's scary when we get to those troughs. It feels like we're losing a lot of money. But when you look at the recovery from the bottom through 12/31, we had tremendous numbers, up 33.5% in corporate bonds, up nearly 60% in high yield CLOs. And so what these rebounds enable us to do is capture, outperform whatever the default levels rise to. So that when we look over the full year, 12/31 of 19 to 12/31 of 20, every single one of these asset classes was positive despite rising defaults. And that this isn't a trend that's just unique to the year of 2020. This happened in 2008, 2009. This happened in 2001, 2002, all the way back to the inception of the high yield corporate bond market, even in the early 90s. So this is something that really is a historical fact. And then the other reason that we really like the high yield market at this point is that when we look at credit cycles and really zero in on what tends to drive them and comfort and support comes into the market, it's when the real nasty bottom of the barrel part of the market starts to rally. So what we've done here is we've stripped out energy from the broad market, and we've stripped out the lowest rated debt from the market. So first, energy. Over the past 12 months, energy has absorbed about 22% of the defaults in the market. That's a third of the overall market. But since September 30th, we've seen about a 16.5% return. If we take energy alone out of the market, we're defaulting at a rate less than 4%, which is hardly above the long-term averages, and we still return 6%. And you can see the same sort of story play out in CCC graded. So to us, that signals that the market is comfortable with high yield. It signals that stability has returned to the market, and we can expect to have returns around the yield and income that it's generating, plus a little bit of growth, which is really our overall target here in opportunistic income. And my last slide just covers the relative comparisons between U.S. high yield leveraged loans and CLOs. So when we look at default rates and protection, and then take that volatility equation into account, U.S. high yields defaulting just north of 6%, leveraged loans are defaulting around 4%, but CLOs, which are typically more volatile, are defaulting at a rate of 1.35%. So when we're earning a yield above 7%, nearly 200 basis points over everything else, 2% over everything else, and we have structural subordination and protection in the asset class, and nearly 1/3 of the level of defaults of loans, that to us screams a huge opportunity, and we think that market is going to do very, very well going into 2021. So the last comment I'll make, taking it up a notch and looking at it overall, the reason we like high yield, full stop, is that our projections are for a 4 to 7% overall return versus what we see as 1 to 2% in investment grade. And when we consider the overall asset allocation decision, we think that positioning here will undoubtedly result in higher returns over 3-year rolling periods or longer. But the key consideration is that we do have to accept higher levels of volatility going forward to get those same level of returns. So I'll stop here and hand it back to Elizabeth.